It's really interesting. But when our lovely government and central banks want to hide things and they want to transfer risk, what do? They take it from something that maybe is more regulated, like the banking system. And I've been hearing a lot of entities talk about debanking these days, but they move it to the private markets where it has a lot less oversight and is even less visible. And that would be true for credit as well. And what we know is that the banks have been shifting, and so they're not giving out loans directly like they at one point did prior to 2008. But guess what? They're still in it. And there is a bubble forming that could definitely topple. I mean, bubbles everywhere. Whichever one is going to topple the system, I guarantee you one will. And we're going to talk about the one that kind of has me nervous right now. Coming up. I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer specializing in custom strategies. And I hope you have one in place, because if you don't yet, hit that subscribe button and hit that Calendly link and set up a time to get your gold and silver strategy, not just in place, but also executed, because clearly we are running out of time. So I'm going to get right to it, because I've been watching this bubble build, as maybe many of you have, in the private credit markets. I mean, we remember after 2008, banks pulled back from certain types of direct lending, but just because they pull back from that does not mean that they're not lending to corporations or to companies that invest in private credit or that make up the private credit pool. In fact, many have been warning that there is a bubble forming in this area. Private credit market has roughly tripled in size just since 2015. That's significant. Of course it has. As the banks pull back in certain areas, well, what you have is you have others that will step in. And in fact, now you've got private credit is so popular with pensions and institutional investors. You may be attached to private credit and not even realize it. Private credit has become an increasingly sought-after funding tool for buyout firms, and banks have pulled back amid a spike in interest rates and a drop in investor risk appetite. Some banks are concerned about this shift as underwriting these types of loans and then selling them to other investors. We're going to be talking about both of that, is a strong source of revenue for them. So underwriting, maybe they're not doing the direct lending, but they are underwriting them, and that puts them at some level of risk, because then they're packaging them up and then they are transferring that risk to you, the investor that doesn't really know what they're doing. So even though it may not be direct, you need to understand that the whole system is incestuously interconnected. And so when a bubble pops in one area, it's going to be felt by all areas. How much they can hide is anybody's guess. But this is a very strong source of revenue for them. They're not going away. They may have pulled back in this area, but they've raised it in other areas. There is clearly an asset bubble going on in private credit. There are many other asset bubbles building. What it needs is just one thing to trigger a fiduciary crisis. So a crisis that they cannot hide. How quickly can that contagion spread between the incestuous interconnection and in the digital age? I fear we are about to find out, because this is the growth. Global private credit debt assets under management. So what we're talking about here is more debt to fund debt. You cannot fix a too much debt problem with even more debt, but they don't have any other solution for it. And once things get in place, then they are ready. They're off to the races, as we can see here. Now, what I want you to realize is that there's this black area is unused capital. So if an emergency crops up or an opportunity crops up, this is where they're going to pull cash from. But look at how much faster the debt, that blue area, and that's just the market value of the current portfolio. Again, all of this could be hiding a tremendous amount of risk. It's like the tip of an iceberg that we can't see until the ship has run aground. Then you see it. So U.S. speculative debt due for refinancing. This is that debt wall, that refinancing wall that we've been speaking about. So much of this debt was taken out. Look at from 2010, we were already in ZIRP, zero interest rate policy. That only changed here. So all of this accumulated debt has to roll over. This is what that looks like. From near zero to speculative debt requires higher interest rates. I mean, are they going to be able to do it? Who's buying all of this debt, right? And could an implosion in these markets trigger the next financial crisis? I mean, there are so many bubbles that are popping right now because of the increased interest rates. Who knows what's going to trigger it? Something that they cannot overcome. We've talked about CLOs, collateralized loan obligations, so much since the crisis because it was the CDOs, collateralized debt obligation, that froze in 2007 and caused the great financial crisis. Even the Bank for International Settlements has raised the warning over CLOs, collateralized loan obligations, as taking over for those CDOs. And what's also happening is more danger signs. So are you paying attention? And you may say, well, I don't have any of that. You might have it and not realize it. But even if you don't, because everything is incestuously interconnected, we're all going to feel the impact of it. That's why it's so important. I mean, you're getting prepped, getting prepared needs to happen before you need to be prepared. We're not going to really know when that exact moment is. But the other problem is in this environment, in this credit environment, S&P lowered far more credit estimates than it raised last quarter. In fact, here's credit estimates and there's the credit ratings. So you can see that the credit ratings have been going down and the estimates for a problem have been going up, particularly and especially since 2023 and the third quarter that we just completed. Can you see how all of this risk is going into danger territory and could possibly impact you in a very negative way? So understand that most of the CLOs, this collateral loan obligations, are floating rate instruments. That means that they're already paying more higher interest than likely when they took it out. In Q3, S&P lowered its credit estimates on a ratio of almost 5-1. That's not good. That's why it spells danger. In a rare glimpse into the opaque world of private credit, because it's not as regulated, and even when they are regulated, they do funny business. But this is even more opaque. A recent review of credit estimates by S&P Global Ratings showed that the quality of debt extended by private lenders to dozens of companies whose loans are bundled into CLOs, collateralized loan obligations, is deteriorating. Well, the other part that I'll remind you of is that these are all contracts, and you didn't write the contract, you certainly didn't read the contract. And when people were reaching for yield, you might remember, I've done some work on this, you can search it in our blog. as they reached for yield, people were not paying attention to any of the investor protections. So as the yields were going down, so were investor protections. So when this implosion happens, people that, I can't say that they really feel comfortable in this stuff because they don't really understand what they've done, but they're extraordinarily vulnerable and they have risked their principal for that little pickup in interest. I've been saying for a long time, you are not getting paid for the risk that you've taken on. And what we see ahead are a lot of defaults. A lot. It means people aren't getting their principal back. Part of what gold does is it ensures that you live another day, right? Because you actually have real money that holds its purchasing power, that cannot be inflated away. That the risk, the counterparty risk that we're seeing with CLOs and other private credit and any kind of debt and any of these contracts, that is all counterparty risk. Gold, according to the Bank of International Settlements, the biggest bank in the universe, gold is the only financial asset that runs no counterparty risk. All this other stuff is complete counterparty risk. And what's the solution? More debt. Private equity makes loan payments with more debt to keep cash. Yeah, they're keeping cash, and I already showed you that level of cash to their debt. But what they're also doing is funny business around the contracts, meaning payment in kind, or PIK, right? Debt shows up in LBO terms to clinch deals. Usage soars as a temporary fix until interest rate spikes ease. So when you hear the Fed talking about higher for longer, this is a big, huge problem. And this even reduces even some, whatever little bit of investment protections still remain. Payment in kind means that they are paying debt with debt. Kind means the same thing. So they're paying debt with more debt. Yeah, you should feel really, really safe about that. At 16% interest, the total amount owned in cash can double in 5 years. It's hard to pin down how much PIK, so payment in kind, is circulating because private loans aren't always reported. Shocker! Bloomberg's database tracks at least $73 billion outstanding on various types of PIK borrowings. Almost all of it rated below investment grade, and some coupons are topping 20%. You cannot fix a too much debt problem with even more debt. It simply exacerbates the problem. And it doesn't matter who you are, even me, I'm more prepared than almost anybody I know, and I'm still going to be impacted by it. Not so much in a negative way because I have my food, water, energy, security, barterability, wealth preservation, community, and shelter. I have my bug out, so I'm luckier than most. But I'm telling you, what are you doing to protect yourself? This is what you should be doing. This, along with all of the other levels of the mantra, building community is arguably, after you have your money right, the most important part of the mantra, building that community to support your ability to sustain a reasonable standard of living now, globally or locally, and to prevent the full surveillance, full control economy they have in mind of us, for us globally. All accounting tricks do is they hide, and maybe they postpone it because of the awareness is just not there. But you have to understand, this is a very opaque market. It means you can't really, it's hard to pin down how much PIK debt is circulating. It's hard to pin down how much private equity debt is circulating. So it comes out of the blue, and by the time you know it, it's too late to do anything. But hey, Pimco sounds the alarm, and Pimco is a big bond fund under regulated private credit markets. Lack of transparency and oversight seem posing investor risks. You think? Risk is transferred from regulated banks to pensions and insurers. And what that really means to you. You realize that? There's been an evolution into private markets. Before the global financial crisis, the risk was inside the banks. Now it's outside. There's been this big transfer of risk to investors. The question is, when will the regulators start looking? After the next big crisis. That's when they always start looking. And because, look, I can't prove this. This is just my opinion. But they're all in this together. You got the 1%ers and then you got the 99%ers, the rest of us. Who typically eats it in the shorts? We do. This is risk transfer 101. Regulators aren't going to look at it until the fox is already out of the hen house. It's staggering when you look at what happened since the global financial crisis and how much more leverage there is in the system. The difference is that this leverage is more hidden even than the leverage that's hidden inside of the banking system. We have no flipping clue where all of this leverage is hiding. No clue at all. How does that make you feel? Makes me darn glad I got food, water, energy, security, barterability, wealth preservation, community, and shelter. Let me tell you that. Because the time to get prepared is while you still have that ability. And I've been working on it for a very long time. The majority of investment managers at pension funds, insurance companies, who's really in the pension funds and insurance companies? Family offices and wealth managers surveyed by blah, 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 said they plan to even increase allocations to private credit in the next year. Let's double down, because insanity is doing the same thing and getting this different results. Are they not paying attention to how opaque these markets are? No. They're just like lemmings. They just go with the flow because they're not really at risk. You and I are. We're the ones that are at risk. Private credit tops wish list for Australia's biggest investors. And who might that be? Pension funds. I guess this is one way, and I'm going to talk about this more going into the new year. Pension funds seek to increase allocations to this asset class. Who's impacted by these pension funds? The normal person, right? The normal person. And so, I guess this could be one way to say, well, who could see that coming and take care of their big, huge retirement crisis that we're already experiencing? Floating rate debt deals help hedge against inflation. This is their flippin' justification. How might a crisis in private credit impact retirement funds? So they're saying, no, this is a hedge because, as I showed you before with CLOs, that's all floating rate debt. So the theory is that it pays you more because it's floating rate debt, but the corporations still have to have the ability to pay it. So what are they doing right now? They're taking on more debt to pay the debt that's owed. Do you think there's no limit to that? I mean, seriously, do you think there's no limit? Australia's pension funds, the world's fourth largest retirement pool, are seeking fresh places to deploy their record inflows. See, if they can make things through inflation look like people have more money to work with, they can keep this inflation thing going as long as they can keep growing debt. A debt-based system requires new debt. It's a Ponzi scheme. While they've been piling into unlisted assets like private credit, regulators are starting to tighten oversight of the often opaque area where valuations can be less frequent and disclosure patchy. And how about valuations can be more random? Can you see that this is an accident waiting to happen? Because this area, often opaque area, where valuations can be less frequent and disclosure patchy. I've shown you where banks are doing that too. On these assets that have no market, can't they just say that they're worth whatever they feel like it? And when you're looking at private credit, what is this? Don't you remember the unicorns? Worth $1 billion, but losses as far as the eye can see. They don't need to make money. They're worth billions of dollars because why? Because private credit said so. Thank you, WeWork. I mean, that was really an accident flipping waiting to happen. Saw that from the beginning, the maturity mismatch, and look what's happened, right? They're no more. Oops. Too bad, so sad. What could ever go wrong with this kind of a setup? Can't imagine. Everything should be just hunky-dory. And of course, the higher for longer mantra. Powell pushes back on rate cut bets, but markets push back harder. He's lost his credibility. The central banks have lost their credibility. Do you remember, were you with me? What was it, June 2021 or 2? I have to go back and check now. When they handed their credibility away. Well, I think it was 22 maybe. Because they kept promising the markets a 50 basis point move, and then they did 75. And the markets knew at that moment that they couldn't trust what the Fed said. And now the Fed and all central bankers are fighting for their credibility. And that means that they will push back harder. But the markets, with all that leverage, can easily overwhelm the Fed's ability to paper over this next crisis. I don't think they're going to be able to do it. Maybe I'm wrong. I mean, I can't guarantee that, certainly. But Federal Reserve Chair Jerome Powell attempted to push back against investors' growing expectations of interest rate cuts in the first half of 2024. That's why interest rates are down and bonds are up. Remember, interest rates, market value of bonds. Okay, so what happened? What did Powell do? He raised the interest rates really fast. That's created all sorts of ripple problems in global banking, in debt, in any debt, in mortgage debt, in car loan debt, whatever. All these banks are completely underwater after 15 years of zero interest rate policy. But if the Fed turns around, the one rate that they can control, that overnight Fed funds rate, and they start pushing down on that, then that brings the market value of those bonds and all those debt instruments up. And this is the soft landing that he's trying to engineer. There will not be a soft landing. You can mark my words on that, puppy. This is not going to be soft. This is going to be harder than any landing that you and I have experienced in our lifetime, because this is bigger than anything we have experienced in our lifetime. This is the end of this debt-based paper system going into maybe a debt-based, maybe a purchase-based surveillance system. How do you fight it? Yeah, get out of the system. Real money that has massive market, the most liquid asset that you can do because it's used in every sector of the global economy. Definitely. An accident waiting to happen. I just can't tell you the exact moment. And in the meantime, what's happening with spot gold, which is just a contract? Well, we've been talking about the triple top. We have had a breakout. Now, it must happen in a pervasive way, but my bet is that it will indeed, because triple tops are extraordinarily rare. When I first put this chart together last Friday, as I was working on it, we were testing and forming a quadruple top. Well, all that was over. And here is just a 1-year chart, and there are a few things that I want to show you on it. Number one, I want to show you this gap, right? Remember when I've explained these patterns, right? If you can understand the pattern, you don't have to fully understand it, but if you can see the pattern, then it gives you a clue. And what having a gap in a chart tells you is that at some point in the future, can't tell you when, but at some point in the future, so it could be this week, could be next week, it could be a month, that the spot price will go to fill that gap. So when you see spot gold pull back and go down, that's all it's doing is filling that gap. The fact that it's had a massive breakout, I mean, the high on this was 2152.30. Now that's where it was way up here. That's not where it closed, but it went up there. Isn't that interesting? That was a big breakout. It's like holding your hand on a spring. And when you remove your hand, the spring shoots in a direction. When it happens to the upside, like with spot gold, you can see it, bam, shoots right up, okay? So I want to be crystal clear on where we are on spot gold, because even with this, it does not reflect the true fundamental value of an ounce of gold, which is more nuanced. This is just Wall Street's version. They can create as much gold as they want to, paper gold, gold that does not nor ever will exist. But when you're looking at this, there's a finite amount, period, end of discussion. And I've shown you, I think even last week, I showed you the difference between this paper market and the tangible market. The physical only market broke out a long time ago, and the market that is only for the 1%ers is at all-time highs, all-time highs. This is not yet at all-time highs, and the premiums have come down. I'll show you that in a future episode. But make no mistake about what is happening in this spot gold market. There is your breakout. Look at how high that went. Be prepared. Could it come down and fill that gap? Well, at some point it's going to. So quite honestly, I'd rather that happen sooner than later, because then it's just out of the way and I don't have to think about it anymore. I can't tell you exactly when it's going to happen, but it will happen because it always does. The other thing that I want to point out are the moving averages. This blue line is a 50-day moving average, which means that every day for 50 days, they total up where spot closes, they divide it by 50, and it gives you an average. This red line here is a 200-day moving average. And so that means every day for 200 days, they total up where spot gold closes, and that gives you an average. This is purely technical, when the 50-day moving average, so the blue line, crosses the red line, either down or up, when it crosses it to the downside, you see this is not very strong. It didn't dip down super deep, like kind of looks like it was deeper over here, okay? Then you're more likely to get a little bit of downward action. But look at where it is right now. It's, again, right on the cusp of breaking above it. So quite honestly, everything that you and I are looking at on these two charts indicate a higher spot price. This may well be somewhere in here, may well be your last best opportunity to buy actually any physical metal at the cheapest level that you're going to get it. So if you were on the fence, get off the fence and get her done. In fact, get the entire mantra done. Food, water, energy, security, barterability, wealth preservation, community, and shelter. And you're going to have to take that community piece and get that especially done. You want to lay in your foundation, but look, I've been working on this, the gold and the silver, since 2002, and the food, water, etc. since 2010. We don't have it, and I didn't know what I was doing with the whole mantra pieces. So I needed more time, and that's true for most people. I mean, unless you've been doing this and you're an expert, I just don't think that you have enough time to become an expert in it now. So you have to seek those experts out. You can do that at thriverscommunity.com because we're trying to help you wherever you happen to be. If you're an expert, come join us there and help teach people. Build this community. Even if you're not an expert, especially if you're not an expert, we're trying to meet you wherever you are and building this community to what you want to see, because this is our best shot. We're looking at two things. We're looking at a local community and we're looking at a global community for the reasons that I described. Locally, to have that support, because we feel like we're alone, and we're not alone. We're not alone. There's a very strong community around you. You just haven't seen it, but energetically put it out there. Go visit your farmers markets. Go visit your local farmers, your local ranchers, your local chicken ranchers, eggs, etc. Go work on their farms for free. They'll probably give you product to take home. But more importantly, you're developing those relationships. And I think that is critically important because we don't have the time to start from scratch like I did. And maybe I'm wrong about that. No, I'm not wrong about it. Look at this chart and graph. Luke, can we show them one more time, please? Okay. This is the breakout that I've been talking about. Get her done. ASAP. There is no time like the present, and quite honestly, are you ready for this next ride up? Do you have everything in place? Are you holding physical gold, physical silver? If you're not, definitely get that done ASAP. And if you haven't subscribed, get that done too, because we need to keep you informed of what's going on. We're about to enter 2024. This was a very interesting year. I told you there would be a crisis during this year, and hey, that regional bank crisis was just the kickoff. What's going to happen in 2024? Well, I think we're going to have a crisis in the bond market, and likely the treasury bond market, which is really, really scary, since that's the foundation of the global financial system. If the foundation of your house were moving like this, are you staying in that house? Or are you getting out? Make sure that you watch the most current video, securitization market breaking down, because that, my friends, is serious. That's another black swan that's flying all around. We have so many of them. Which one's going to topple the whole system? It's hard to say because there's so much leverage in this system, far more than there was in 2008. But again, we've put together a crack team on our desk. Daniela Cambone, Taylor Kenny, we all approach this information a little bit different, with Daniela doing incredible interviews, very high level people, me doing my deep dives, and Taylor breaking it down in 101s. We're trying to get you as educated as possible so that you have the ability to make educated choices that puts your best interest first. What a concept. So again, if you haven't, make sure you subscribe, hit that Calendly link below, get your gold and silver strategies set up, get it executed, leave us a comment, give us a thumbs up, share. And remember, this is your wealth shield. And until next we meet, please be safe out there. Bye-bye.